Good evening, friends. Welcome to this webinar organized by IMC Chamber of Commerce and Industry with NCDEX. NCDEX is India's leading agri-commodity derivatives exchange and one of the oldest. IMC is a 114-year-old Chamber of Commerce. It was established in 1907. And therefore it has a tremendous amount of track record and work that it has done. And more important, I want to mention the SEBI has recognized IMC Chamber of Commerce as one of the training institutions for commodity derivatives. Across the country, about 20 or 22 institutions have been recognized. Most of them are educational institutions. The IMC is the only Chamber of Commerce to have that distinction of obtaining a recognition from SEBI as a commodity derivatives training institute. So with this background, we are going to discuss today how do we manage commodity price risk in VUCA times. Okay, the times are so volatile, so uncertain, so complex, and so ambiguous. I think it's going to be extremely challenging for all the market participants. How do you manage? And therefore, with the permission of my co-panelists, and I want to introduce to you, of course, Sumit Gupta, who is the director of McDonald's Pell's Global Commodities, and I want to introduce Kunal Shah, well known. He is always on the television. That is where I see him. He's from Nirmal Bang, and of course Kapil Dev, Chief Business Officer from NCDEX. And my name is Chandrasekhar. Therefore, I think we will, without much ado, we will take off. Allow me just a few seconds for me to share my presentation. Here goes my presentation. Share screen. Yes, I'm with you. Great. So I need to now go to slideshow from the beginning. All right. So we are here. And as I mentioned, yes, this is managing the commodity price risk in times of VUCA. And VUCA is a buzzword in the last 3 or 4, 5 years that we have heard so many times from so many different parts of the world. Volatility, uncertainty, complexity, and ambiguity. And how do we manage? How do stakeholders in the commodity ecosystem, how do those who have exposure to commodities, particularly agri-commodities that we are going to be talking about today, how will they manage this risk? Number one is managing price risk. Number two, does this VUCA time also allow them an investment opportunity? That is what all of us are going to be discussing today. And I want to be very fair to all my co-panelists. We have 1, 2, 3, 4. I think each one of us will get at least 15 minutes of air time, maybe a little more, 20 minutes of air time. We will have the last 10 or 15 minutes for Q&A from the participants. And therefore, without much ado, let me take off. So we live in a VUCA world, which is obviously volatility, uncertainty, complexity, and ambiguity. And we all know how complex the situation is and how dynamic. The complexity is in fact dynamic. It keeps changing rapidly, and therefore it is so important for all of us to keep track of what is happening. Primarily because there are multiple drivers in this market, both global drivers and domestic drivers. Even otherwise, even during normal times, commodity markets are volatile. Without volatility, there is no commodity market. Okay, but currently, these markets, commodity market, both globally and in India, are buffeted by so many different drivers. We'll quickly share what those different drivers are. Okay. Yeah, what those different. Now, let me also talk about a little bit of history. The last 20 years, we had the Y2K boom in 1999 and 2000, and there was a dot-com bust. Those young people may not remember, but I think I'm old enough to remember because we went through all these phases. 2000, 2001 was the dot-com bust. Markets had a huge impact because of this. Although Indian commodity derivatives market was just about taking shape, the policies were being prepared at that point of time. Then came the global financial crisis of 2008, 9, 10, which extended actually till even 2012. And there was a combination of quantitative easing, weather aberrations, and a whole lot of other things in the global financial crisis. We have gone through all that and we have come out of it. 10 years later, exactly, I think every 10 years, there seems to be some kind of an event that's taking place. And now we have the COVID-19 pandemic 2020, 2021. Therefore, we need to learn something from this history of the last 20 years. And what is this history of the commodity market? What does it teach us? Really, it teaches us that don't take the market for granted. Don't take your business for granted. You must expect the unexpected, and you must prepare to face the uncertainties that unexpected changes in business would bring. But these are called as the global financial crisis, COVID-19, the 9/11 attack on the United States. These are called black swan events. The black swan events are very rare, but those events leave a very deep impact on the countries' economies and on the markets. And therefore, it is important for all the stakeholders to build resilience in their investment decision or trading decision, in their businesses and in their investment. You need to build resilience. Okay. Let me talk about some of the fundamental drivers of the global commodity market that every single stakeholder, whoever has anything to do with commodity markets, he or she must track these 6 factors without fail. One is economic growth. There's a strong positive correlation between economic growth and commodity consumption. As economies start to grow, commodity consumption also starts to increase. And therefore, tracking economic growth will give you a good indication of the potential for consumption of commodity. And there are several leading indicators that are available that would indicate the possibility of economic growth with a particular lead time. One of them is, of course, the OECD composite leading indicator. As an example, I want to therefore track economic growth, extremely important. Second, geopolitics, which impacts commodity markets. And why is geopolitics important? And what is geopolitics? Geopolitics is nothing but a political instability, a war-like situation, which creates instability in the world. Okay, and therefore, if this instability centers around what I call the MENA region, Middle East, North Africa region, which is a hub of crude oil production, then there is always a risk of disruption to supplies of crude oil, and crude oil prices will go up. Okay, and then because crude oil is what is called universal intermediate, it impacts every other economic activity, creates inflation, the kind of situation we are actually currently going through. For it's important for all of us to track geopolitical developments, and it also has other impact. For example, when there is a flight to safety because of geopolitical instability, immediately demand for gold goes up because it's a safe haven investment. All that. Therefore, you need to track geopolitics. And also during when crude oil prices go up, there's a greater propensity to divert either ethanol or vegetable oil for biofuel production. But there are multiple impacts of geopolitical development. Then we need to track monetary policy. When government or when central banks follow a very expansive or accommodative monetary policy, there'll be too much of liquidity in the economy, which is what we are facing for the last 12 months, particularly led by the United States US Federal Reserve. or we have an ultra accommodative monetary policy where trillions of dollars have been printed and released in the economy, and interest rates have dropped to near zero in the United States. But the same is a case with several other economies. And when you have too much of liquidity, a part of that obviously flows into asset markets, including the equities market and the commodity market. Therefore, the current boom that we are witnessing can be partially explained by saying that this is a liquidity-driven commodity boom. Okay? Therefore, monetary policy becomes very important. And once the central bankers start to tighten the policy, obviously it will have the reverse impact on commodity market price. Currency, of course, all of us know it's a no-brainer. Everybody knows how a weak dollar pushes commodity prices up, and a strong dollar caps the upside for commodities, etc. So currency is important. Weather for agriculture commodities, weather is a most crucial driver. And we have seen since the last quarter of 2020 how La Nina has taken hold, and how, whether it is wheat or corn or coffee or soybean or other oil seeds, palm oil, for example, all the prices of all these agriculture commodities have, some of them have nearly doubled in the last 12 months. So weather has very significant impact on agriculture commodities, agriculture commodity markets, on production, and on availability, on quality, and of course on prices. Therefore, we need to track weather. Okay. And last but not the least, of course, funds have a significant role to play. In fact, the fund managers usually track the previous 5 factors: economic growth, geopolitics, monetary policy, currency, and weather. And then they will take that decision to either go long, short, or how to trade, how to invest in commodity market. Therefore, all of us have to track those interested in commodity markets, whether as a stakeholder, as a hedger, or as an investor. I think we need to track all these factors, which is extremely important. Now, currently, we have seen, say in the last 12 months or 9 months, in fact, we have seen a massive rally in so many commodities from the second half of last year. We know how crude oil prices have gone up. We know how steel prices are up, copper prices are up, precious metals prices are up, agriculture commodity prices are up, cotton, cocoa, corn, wheat, vegetable oils, oil seeds, you name it. I think the prices have all very, very substantially risen, and which is creating tremendous inflationary fears in many governments, including, of course, in our own country. All these commodities have gained very substantially in the last 1 year in terms of their price. Imagine somebody who wants to who has to source these commodities, and who's probably had a forward commitment to sell a finished product. His raw material cost has been going up relentlessly. What will he do? These are serious risks which stakeholders must bear in mind. Now, at the same time, these are supply side challenges. But in 2020, we also faced demand side challenges. We had COVID, we had the pandemic, we had national lockdown. There was demand destruction, in fact, across the world, disruption to global value chain, and therefore there was a big demand destruction, and demand side was a big challenge. In 2021, because in 2020 there was lockdown and there wasn't enough investment in creation of productive capacities, in 2021 we are now facing supply constraints, and many countries have now started to get out of the pandemic, and therefore there's a big demand surge, probably led by China, and therefore we are facing this. Therefore, this is what is creating huge volatility, uncertainty, and complexity, particularly in the agricultural commodity markets, about which we have got to be very careful. We should know how to manage it. Okay. Now, currently what's driving prices? Obviously, I guess I have already touched upon this, but currently it's a positive sentiment because of the rapid vaccination of people around the world in many countries. The sentiment which was very negative last year, which was very weak last year in 2020, is now gradually turning positive. And therefore, as economic activity starts to recover, and it is recovering, there's a surge in demand for a whole range of commodities, including agriculture. And one of the engines of current demand growth is obviously China, because of their huge appetite, which is driven primarily by the stimulus that the Chinese government is giving. Therefore, currently, what the situation that we are facing is a combination of massive liquidity, low interest rate, and weak US dollar. As a combination of these three, plus you also have rising crude oil, and rising crude oil obviously lifts or supports the entire commodity market. Then we also have had La Nina since the last quarter of last year. For all those drivers that we talked about earlier are all very surprisingly combined. They have combined and they're all operating together. This does not happen often, but it has happened now in the last 10 years. Is the second time that we have seen that this kind of a combination is happening. And therefore, currently, because of this, the markets are moving, because the sentiment has changed, turned positive. Markets which were in a very risk-off environment until last year are now looking at a risk-on environment, which is there is obviously the asset markets are substantially improving through investment, because because investors are very positive about the current environment. Okay. Now, it is in this VUCA condition, it is in this very complex price situation that we need to look at. We need to look at how to manage the prices. Whether you are a producer, whether you are a processor, whether you are an industrial consumer, importer, exporter, only a trader, whatever be your status as a stakeholder, or even an investor for that matter, then therefore we need to start seriously thinking about managing these price risks. Therefore, as we said earlier, multiple risks, both domestic factors and international factors or global factors. And these factors impact production of commodities, the volume of production, quality of the output. There are risks relating to trade. There are risks relating to policies. Governments have become protectionist. Suddenly some government bans something, export or trade of some commodity, whatever. There are restrictions. Therefore, there are multiple risks which the stakeholders face. Now, the beauty is all these risks, production risk, quality risk, trade risk, policy risk, all these risks converge into one factor. And that single factor is called the price. Price is one factor that actually encompasses all the underlying risks. And whether it is a primary raw material or an intermediate product or a finished product, finally, it is the price that we have to be looking at very, very clearly. And the price is the ultimate market reality. I think in the market parlance, we always say, Bhav Bhagwan Che. Price is the ultimate reality. Nothing is more sacrosanct than the price that the market is recording or is facing currently. And therefore, if we are able to manage the risk that arises out of price fluctuation, we would have indirectly managed all the underlying risks of production, quality, trade, policy, etc., etc., etc. Therefore, whether you're a producer, you're a processor, industrial consumer, trader, exporter, importer, if you manage your price risk, you have managed your underlying risk. Is a primary message that I thought I should share with this audience. Now, how do you manage your price risk? The process of managing that price risk through the derivatives route is called hedging. Okay, so managing price risk using the derivatives contract is a time-tested scientific method, and we have been talking about it for at least 20 years, from the time 2002 or 2003, from the time commodity derivatives were allowed and national exchanges with online trading were set up, we've been talking about the fact that it's a time-tested scientific method. More important, this is a very well-regulated market. Until 2015, we had Forward Markets Commission as the regulator of this market. But after that, it's the SEBI, Securities and Exchange Board of India, which has taken over. FMC was under the Ministry of Consumer Affairs. SEBI is an autonomous organization, and SEBI constantly engages in activities and in policy initiatives to deepen and widen the commodity derivatives market. In the last 2 years, several new products have been allowed. Several new participants have been allowed to enter this market. For example, mutual funds are now allowed. Alternate in AIF category 3 is allowed to invest in this market, and a lot more is going to happen in future also. And of course, from a new product perspective, for example, you have index trading. You have options contracts which are permitted. For example, NCDEX has a wonderful contract, index contract called the Agri-dex. And therefore, it is important that, sorry, even if you don't have a genuine stake in the underlying commodity, you can still invest in the market, in this derivatives market, because beyond hedging, you can profit from the VUCA conditions in the market, the volatility in the market. If you're a savvy investor, you can actually benefit from investing in this commodity. Now, it's certainly an investor's delight, because to draw benefit as an investor, you need adequate product knowledge and adequate market knowledge. This is extremely essential. It is not that somebody told me to buy this commodity and I bought. No, I think you need to do your own research reasonably. You should be networked, you should be talking to people, there's no doubt at all, but you should also know how to do your own research. And a lot of information is available on various commodities, and therefore your trading decision, your buy, sell, hold, whatever decision, in my view, should be based on research and on commercial intelligence. And your entry and exit strategies have to be in place. And I have always said, more important than the entry strategies or exit strategy. Okay, and therefore be very clear about booking your profit, about cutting losses, etc., etc. And therefore, if you're an investor, you want to be a savvy investor, do your research, gain product knowledge and market knowledge, and stay completely tuned to this market. And I think you will certainly thank me for this advice, maybe at a later point in life. Thank you very much. Good luck. God bless. I want to issue a disclaimer very clearly. I'm not a trader. I don't hold any position anywhere, neither in the physical market nor in the derivatives market. I'm a student of the market. I'm also a teacher of the market. I teach this market in several institutions. Therefore, I will stop here. I'll stop here. I'll end my presentation, and then what do I do? I think I should request now. Let me call Sumit Gupta. Let me invite Sumit to share his thoughts. Yeah. Sumit, do you have a presentation?
Yes, sir.
Oh, lovely. Please share. Please share.
Yes, perfect.
Oh, yes, perfect. Thank you.
Sir, first I want to thank you for such an informative presentation. I'll be reiterating most of the points mentioned by you. And because as Chandrasekhar sir has mentioned, VUCA or volatile, uncertain times or complex and ambiguous times is nothing else, but it is a changing condition. When somebody asked Socrates, "What's your view about the young?" He said they are obnoxious, they don't respect the seniors, and they don't know when to talk. So the view about the youth has not changed even after 2005 years.
Absolutely, you said it. Lovely.
So largely the point is, at every situation, every time, times are changing. But the pace at which times are changing, we have to adapt ourselves to it. And thank you, NCDX. Thank you, Chandrasekhar sir, for organizing such an informative or timely topic, because we are getting away from one uncertainty of COVID and getting into another uncertainty of post-COVID world. Because
Yes.
post-COVID world will be equally uncertain, because if bad news is volatile, good news is equally volatile. And how we are going to manage our risk, manage our business is going to be the defining factor in days to come. So this is, as sir has mentioned, VUCA is nothing else. It's an acronym which is getting very famous these days: volatile, uncertain, complex, and ambiguous time. And what happens? You always have to look at the risk-adjusted return. Every factor in this brings its own uncertainty, brings its own risk. Okay. And I have asked an entrepreneur, do you get up in the morning and ask कि आज risk कहाँ पर लेना है? They said, no, we don't ask कि आज risk कहाँ पर लेना है. We always say कि how we palm off our risk, कि हम अपना risk कैसे reduce करें and make money out of it. So the entire situation is nobody likes to take risk. Everybody wants to minimize risk in their business and make money out of it. And we have to look at the risk management, good risk management practices, financial literacy, understanding of the futures, derivatives, instruments, which can help us to palm off our risk to someone else who is better equipped to take that risk, or the one or a speculator who wants to take that risk for profit. Because a hedger comes into picture when he wants to do his business, make his margin out of a processing activity or certain other activity. A speculator comes into position when he believes, no, this price is not right. I want to profit from the movement of price. So the entire activity is to palm off the risk to someone else and look at the rewards by the consistency of business. And this is about the pace of change. Why this is important? Because electricity took almost 100 years to become popular. Telephone took almost 130 years. Mobile phones took 15 years. And the pace at which technology is changing in our life, that means our businesses will change at equally fast pace. That means the businesses which had a life of 100 years, 200 years, till year 2000 or before, because of the technology, their lifespan will go down. So to make to increase the longevity of our business, what we will need better risk management practices, better aptitude towards what is happening in the external world. We need to adapt ourselves better, and that will not happen only by looking inside what is happening inside our business. It will only happen by looking it will happen along with looking inside what is happening in the external environment, how external environment is changing, how complex it is getting, how it is impacting my business, how I need to minimize my risk in the changing time. And this is the reason, with this kind of with this kind of volatility, this kind of changes coming into business, we have to adapt ourselves to face the changing times. These are the black swan events which have happened in last 50 years, uh, right from the Black Monday of 1987 to 2000 crash, to 2007 financial crisis, and which is the latest in our memory is COVID, which was declared as a pandemic in Feb and March, and virtually everyone was impacted throughout the world by this pandemic. This pandemic has made governments, as sir has mentioned, to look towards the expansionist policies. Why? Because the role of the government is to look towards the least resourceful person in the country rather than the most resourceful. So that's where they have to expand their monetary policy so that helicopter money, the resources reaches to the most wanted person. And that is where we are seeing there is an expansionist monetary policy followed by all the rich nations of the world. And because of that, actually the value of commodity has not gone up. The value of dollar has gone down. And because of that, you need to spend more dollars to buy the same commodity. And that is where we are seeing the inflation in the commodity world. Just to give example, price of corn has gone up by 100%, price of soybean has gone by 100%, price of copper has gone by almost 120%, price of other feed ingredients have gone by almost upward of 100%. So if being a poultry processor in India, it means his life without his any sin, because without him creating any additional demand has changed. The prices in Indian market have changed forever. If it is not raining in Brazil, people are buying corn out of Bihar. So the world has become so international, it has become so intricate that we cannot look towards risk management, we cannot look towards our business without looking what is happening across the world. This is an example of Blockbuster versus Netflix. It's happened in the same way. When Blockbuster was a $2 billion company, Netflix was just started. Today, there is no Blockbuster because they have not looked towards the changing technology, changing times, the VUCA times, and we all have to live in a changing environment. The life of the businesses is going down, as we have discussed. Wikipedia, encyclopedia survived for almost 200 years, and it has to go out of business in last 15 years because of Wikipedia. The world is becoming an open platform. We have to look towards knowledge wherever we can. And why it is linked to commodity? Because commodity business is no different from any of these businesses. Because our business is imbibing the technology at the least at the moment, and the technology is going to impact this business more than any other business, because the risk management, sophisticated patterns are involved, and the people who want to understand those patterns and get benefited out of those patterns are going to bring this technology into this business. And our business is going to become more volatile, more international, more impacted by the global policies. As a country of 1.4 billion people, which is, you can say, almost equal to China in population, and almost one third in the consumption of grains and oilseed against China, our consumption is bound to go up. And consumption is bound to go up. Either we increase it by technology intervention in Indian production, or we will have to become an import-centric country, or we have to become self-sufficient by having a better technology intervention in the seed space. So technology is going to be the game, either in the input or output. And especially the processing segment in India has to equip itself to understand better price risk management practices, because India will no more be an island of production of its own supply chain. India is now getting internationally linked, especially when prices goes up. India become internationally linked in La Nina years. In El Nino years, we become an importer. So as a processor, we have to see which weather pattern we are living and how it's going to impact our market. And especially as mentioned, change, it is important to adapt ourselves, especially in the changing times. And this is where the understanding of risk, exposure, probabilistic thinking, we don't have to think in absolute terms that 1 plus 1 is 2, or 1 plus 1 is going to lead me to this profit. No, you have to see what is the probability of things going my way as per my strategy, what is the probability of things going wrong, and how I am going to risk manage in the situation where the things are going against me. The consistency of returns, because market loves consistency, and we have to make sure that we are bringing in our business are going to eliminate or reduce our commodity risk and make our returns more consistent. For that, right assessment and understanding of risk is important, and role of discipline is very important, especially when it comes to commodities. What is risk? Risk is, in financial terms, uh, a change in uh, 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 it's a difference in outcome from the expected outcome. So Greeks used to define probability as goddess Fortuna. That is that's the goddess of fortune. They believe that fortune used to bring reduce or eliminate risk for them, but that's not the case. It's the understanding of mathematics, probability, which helps you better understand goddess Fortuna, and that makes you lucky, and that makes you stand in front of opportunity to make best out of it. And that is where we need to make our business, our models more mathematics oriented, more system oriented, more process oriented. And that is where we have to understand what is risk assessment, what is the probability of an event happening, and what is the severity of the event. If the severity of event is quite big, for example COVID, and it happens once in 100 years, we need to reduce our risk limits. We need to get out of the positions at that moment. We need to become very secure, or we need to run our business through hunkering down. And there are the risks which are very common. It happens every day, like currency fluctuations. We need to have risk management policies for that. And so it is very important to understand risk, assess risk, and take our decisions accordingly. Chandrasekhar sir has explained the price concept of price, which is a very important concept. Price is nothing else but the combined psychology and all the factors put together in one number. And and price goes up if there are more buyers, if price goes down if there are more sellers. It is as simple as that. But to decode that price, we need to have a sharp understanding of supply, demand, reasons behind it, the factors of volatility, and it is going to define our risk management. We cannot say today price is this, what is your expectation of price tomorrow? That's not the right way of looking at it. We have to look at it, what are the factors which are today responsible for the current number, and what are the factors, how they are changing and how it may impact the situation tomorrow. So a deep understanding of supply and demand before getting into risk products is very important. We need to read a lot, we need to understand, we have to look at the mega trends, local factors, regional factors, what is impacting the prices. And that is where we have defined a correlation between Bihar and Brazil. This year there was a less rain in Brazil during Feb and March, which has led to reduced production of their safrinha crop. And because of that, Bangladesh is not able to import prices corn from Brazil, and that is the one reason why Bihar corn prices have shot up unexpectedly. So that is a very that is one connection between the carnival and the litti choka of Bihar, and these are the connections in commodities which are everywhere. So we have to look at not only at the regional factors that okay, Bihar crop is big, I should go short, or I will get the supplies comfortably. No, it is not about Bihar. It is not about corn. It is about how crude is behaving, how Middle East region is doing, what is the OPEC policy coming, how, because crude is nothing else but energy. Corn is nothing else but photosynthesis converted into carbon energy. So everything is energy. So we have to understand it in simplified terms. We have to look towards the global factor, because today government is not protecting us or the consumer from the export side, because government wants export so that farmer can get a good realization. So whenever global prices will go up, Indian commodities will go out as export, and that is going to impact the prices on the higher side. This is the corn S&D. The number clearly says that the S&D or the ending stock this year are going to be significantly less only because of exports. If this exports were not 2.5 million tons, then the ending stocks are very comfortable. That clearly highlights, especially towards the international connections or how the international S&D can impact Indian S&D, and that we have to especially look at the tight carry out years. And this again, just to end it on a note that VUCA is not of our times. This is not about we are talking it during this time. It happens every time. It happens in every phase, every generation. What is more important? How we deal with it, how effectively we live through it. Because companies will sustain, but who will sustain? Who will live through that phase? Will be dependent on the right risk management practices, because it is a Greek analogy which I want to put in front of you. In year 500 BC, Thales was actually stargazing and was moving on the road. He fell into a ditch, and somebody asked him, "You stargazers, you don't know anything." He said, "Okay," and he looked at the star. He said, "Okay, next year it's going to be bountiful rains, and the production capacity of olive oil will be in short supply." But he didn't have money to buy olives or sell olives. So what he did, he went out in the market, originated some money, and booked the production capacity of olives by giving them 10% security deposit as option to process olives. Olives production went up 2 times. He made a lot of money by selling his option on processing. So it is important to understand how you take risk, how you understand risk, you assess risk, and how you benefit yourself from the risk. So this phenomena is not in year 2020. This phenomena is thousands of years old. What is more important is to adapt, and especially as Indians who like risk taking, it is important for us to mitigate risk, understand risk, and then take risk. And that is where I will say, as a trader, we have to be result oriented. We have to be process oriented, not result oriented, because sometimes we make money and we are happy, oh, futures are good. But next day we lose money and say, no, no, there is a speculation going on. Everybody is wrong on this market. This market is not representing fair price. That's not the way to look at it. Every time when we get into a trade, we have to understand why we are getting into this trade. We need to have a right process behind it. And once you have a process, you will stop looking at a trade as speculation. You start looking at a trade as a process. And that is more important, especially for the processors and consumers. And this is the emotion map all the traders go through. But what's more important, that we don't have to be on the wrong side of it. A lot of time we can be on the wrong side of it, but it's, as a trader, it is important that how much money I'm ready to lose rather than how much money I want to make. Because if your risk management practices are right, you will have a good stop loss strategy. You will look at the right fundamentals, and potentially if trade is not going your way, you will say, okay, my process was wrong, something was not right which I have calculated, and you will get out of that trade. And that shows us, or that takes us to a view that risk assessment and risk measurement is the key to success in this market. Thank you very much. I mean, these are the case studies, but I think we can live without it. Thank you.
Thank you. Thank you, Sumit, for this very interesting presentation. Yes, I particularly saw that iceberg where you said seen risk and unseen risk. Unseen risks are far greater than the seen risks. I also, in fact, use another term. I call risks unforeseen risks and unforeseeable risks. There are two kinds of risks actually. There are some risks which are unforeseen, but there are also risks which are unforeseeable. Therefore, probably COVID is one of the unforeseeable risks. Anyway, but very interesting. Thank you very much. You made the point well, that we are living in these times. Our investments, our risk management has to be process driven, which is extraordinarily important. Thank you very much. If you can, okay, I think take your stop sharing screen. I'll ask Kunal to talk about his views, his thoughts. Kunal, do you have a presentation?
No,
I'm going to speak extempore.
Yes, I'm going to speak.
I know. Good, Karo. Yeah, go ahead.
Yeah, so good evening, everyone. So it has been a very thoughtful session by Chandrasekhar ji and Sumit bhai. I think going forward, I first would like to thank NCDX and IMC for providing me this opportunity to share my thoughts on the markets. So first of all, I'd like to take from where Chandrasekhar ji and Sumit bhai has left. As far as these times, okay, these are very different times. So like we heard it, yes, this kind of black swan events, this type of markets where you see such a great volatility, uncertainty, ambiguity, it is there. But this time it is surely very different. And why this is very different this time is because we have not seen in the history of financial market this kind of money printing. So we are definitely in some very different time right now, and where for the price forecasting, for assessing the risk, it requires a very strict price risk management. So I'll give my example of what happened with crude. So who would have wondered when somebody saw crude oil 1 year back on a day of one fine day of expiry in the month of May, minus 40 to minus $35, and who would have imagined
April last year April.
Yes, so who would have imagined that the prices will go up and test $80 for the Brent, and even WTI $75. So this brings the case of price risk management in today's era, because we have not studied in the textbook that the prices of commodity due to any damn reason can go into negative. So what happened in last 1 year has defied what is being taught to us in economics. A prices of commodity can never go negative, okay? But we've seen, that happening, and even the exchanges internationally were adapting to that scenario where the oil prices can drop and test negative pricing mechanism. So this is very different time, and right now the way central banks are printing money. So for example, let us take example of what US Federal Reserve did in 2008 and what they did right now in 1 year. So earlier, the US balance sheet, the stimulus pack, the size of stimulus package, used to be around $500 billion, $700 billion, and the balance sheet was expanded by 2011-12 to almost $2.5–3 trillion. And suddenly, in last 1 year, we've seen US central bank's balance sheet expanding from $4 trillion to $8 trillion. So when you talk about liquidity printing to the scale of $3.5 trillion, I think this is madness, and this has defied all the theories. So the main reason why all the commodities are up, forget about for a few minutes even in agriculture commodity, let us forget about La Nina or the shortages which is being created due to the global supply shock and everything. But the main thing for the root cause of the commodity prices to go up is this money. Your money is basically losing its value. All commodities are dollar denominated, and the dollar is losing its value. Forget about dollar index going down from 100 to 90. That is not that is not the real measurement. The real measurement of dollar's value is when there is a sharp deceleration in the value of dollar. So if you would have heard the news, Russia is no longer holding any not holding any dollar reserves. So they've got rid of all the dollars. And we've seen a report coming out today also stating that more and more central banks are going to get rid of their dollar holdings. So what does it mean? The commodity which are dollar denominated, the value of that dollar is going down, and hence first the value of commodities are shooting up because of that. So price is another thing. I'm talking about the value. Your currency is losing its value, and hence the commodity prices are moving up because all of the commodities are dollar denominated. And that is what is basically the main root cause of this bull run. So when we did one webinar with NCDX in last May, when NCDX successfully launched its Agri-Dex, at that time we clearly mentioned that this is going to be one of the best investment for the diversification, because irrespective of what are the fundamentals of spices, what are the fundamentals of oilseed, what are the fundamentals of cotton, what are the fundamentals of all the agriculture commodity which is listed, all commodities are going to go up. Some have outperformed, some have gone double, some have gone up by 30%, some have gone up by 50%. But the fact is, not suddenly the fundamental of all agriculture commodity became bullish. The root cause of this bullish trend is this massive liquidity chasing handful of commodities and the various financial instruments. So that is the reason why the all market participants, may it be farmers, may it be food processors, may it be companies which are consuming these commodities, all of them should hedge their price risk through exchange NCDX. So the strong cases, if you see the results of all the IT companies, okay, they are clearly coming up with a strict mandate of hedging their foreign exchange risk, because all their revenues are basically denominated in currency. So their risk is basically mitigated by hedging their currencies onto the banks or in offshore market or on the Indian currency derivative market. Same way, the time has come where understanding that in this kind of scenario, even there is central banks are going to reduce the liquidity or no. But the fact remains is that the uncertainty which is going to be there in the system for far longer than what anyone can imagine. So if you ask anybody what is going to happen 1 year down the line, what is going to be the liquidity scenario, where the prices of ABC asset class, may it be equity, may it be commodity, may it be gold, may it be agriculture commodity, where they are heading, it is very difficult to determine, because if the Western central banker starts to unwind their excess liquidity which they have thrown in the market, the prices of all these assets are going to go down. So the demand supply at that point should not matter. So even if the fundamental of particular agriculture commodity is bullish, but if the Federal Reserve has started to squeeze their excess liquidity from the market, then I think irrespective of the fundamentals, the prices of commodity will start going down for that time being. So the fact is that all the market participants, there is a strong case which is developed, and to have strict hedging mandate within the organizations, within the people who are using the commodity or producing this commodity, may it be farmers, may it be FPO, that they are. So for example, I'll give you the best example of say soya bean, which is trading at right now at say 8,100, 8,200. A farmer may be trading at 77, 7,800. But let us say, if for example, this is just a hypothetical example, that India's production because of the higher prices goes up by 30%. This is a hypothetical example. Then what will happen to farmers? What I mean, as on today, they are able to sell, they are able to hedge their risk at 7,700, at 7,600. When the actual arrival of crop will start after 3 months, at that time, if prices goes down by 30%, then how they are going to manage those price risks? So for producer point of view, and even from the end consumer point of view, the hedging is becoming very important tool. And we have seen the era where the volumes on the Indian agriculture exchanges used to be 10,000, 15,000, 20,000 crores. And at that time also, the hedging participation was the key strength, the fundamental strength. And like we heard from the previous speaker, the size of India's economy is going to grow by from $2.5 trillion to $5 trillion in next 4 to 5 years. As of now, India is a primarily agrarian economy. So just imagine the kind of transition which we are going to see in next 3 to 4 years, and the kind of volume growth which is going to come in the food market. May it be pulses, may it be grains, may it be spices, all these segments which are listed on NCDX. We are going to see phenomenal volume growth, coupled with lots of volatility, coupled with lots of ups and downs, weather anomalies, and at the same time the macro scenario which is also affecting the prices. So I propose a very strong case of hedging to all the market participants who joined today. Please, even if you are producing it or even if you are consuming it, you should hedge on the NCDX. And NCDX has been acting a main pillar of the Indian agriculture market. So that's my message. Start hedging on the exchange. Rest of the topics have been covered by the previous speakers.
Thanks, Kunal, for this very passionate suggestion. People have to start hedging. There is no doubt at all. You can't wish risks away. You can't wish away risks. There is no doubt. Risks are always present, and you need to learn to manage those risks. I have a question for both Sumit and Kunal, but I think before that, let me request Kapil to share his views on the topic. Kapil is like our Kapil Dev of the Indian cricket team. For the commodity market, we have a Kapil Dev also, like the Indian cricket team. Therefore, Kapil, just share your thoughts, and then I will move into a question.
Thank you, sir, and good evening, everyone. And first of all, thanks to Sumit and Kunal to setting the context so well that I just need to say you should hedge. Why and when is all has been said. But given the chance, I would like to speak few points. You know, the VUCA is not a new thing, right? Maybe we look towards the health insurance when we are ill. And right now things are a little more uncertain, and that's what this VUCA or HORECA and all these things are coming out, and we are discussing so aggressively. You know, if there is a news like right now rains are there and everybody's talking about monsoon, every record, you know, we are registered in terms of high temperature or high rainfall comes with one more news, that the similar temperature we have seen in 1920 in Delhi. After that, this is happening again after 80 years, after 100 years, after 60 years. Means events are supposed to happen. They have happened in the past. They are happening. We may think it is first time for us, but no. This is something which keeps on continuing. It keeps on happening. And there are always some records which are broken every time. So volatility is something which is always there, which will remain always there. It may be high, it may be low. But uncertainty and volatility definitely cannot be removed from this ecosystem. Yes, a lot of new things and challenging things has happened in last 1.5 year, which at least for our generation were quite new. Uncertainty on every front, whether it's business, health, personal life, finance, everything. We have seen a lot of uncertainty, and I think that has made all of us a lot more aware about risk management. I have no doubt that now 70-80% of the people who understand the risk have now having health insurance with them, and they are very closely uh, looking out to have it, or maybe to increase the premium and increase the coverage. That is all what uncertainty brings. Now I'll come to a few points that what is the uncertainty, right? So just few points I would like to discuss. The production of all the major food grains in the country have increased in the last 3 years, right? You name any food grains, chana, pulses, we talks about volatility from 110 to 126 means lakh ton. Uh, Even the soya bean, as per the government numbers, from 11 million ton to 13 million, rapeseed from 91 lakh to 99 lakh, wheat from 107 to 108 million ton, and vice versa in all other commodities. What it brings, you know, this increased production brings the highest ever price. We are talking about prices are double. Almost all the commodities are trading at the life high, the highest ever volatility. Just for an example, the average volatility of bean, right, used to remain 15 to 18% roughly in a good year. What it is this year as till date, 35%. RM seed, again, the volatility you won't believe was around 13 to 12%, 12 to 13% in any of the normal year. This year volatility is 33%. And you name any commodity, I think volatility is almost up by 10 to 20% minimum. And the range, the usual range for volatility in commodities from 15 to 18 have now reached to 20% plus. And in certain commodities, 30 to 35%. This is a dramatic change. Earlier, these kind of volatility used to exist only with some very specific commodities like turmeric or jeera, or very small and high volatile commodities we used to say. But now that's now similar across the commodities, right? And I think that's the uncertainty and volatility we are talking about. Second thing, we need to understand that information flow has become so fast. And if you see the way informations are being used for trading decisions, or the impact they have, is much faster than what it used to be maybe a decade back. And Sumit has given a right presentation that cell phone growth, the penetration is so huge, right? And we don't have that much of time that we get the information, we analyze that, we put into some study, and we get some result, and then we start taking decision on that. No, now we do not have those kind of flexibility and liberty to sit on the information and act on that. You have to be very fast, you have to be very well connected, and you have to be superbly sharp to use that information and making a trading decision. If you will not, somebody else will do that, right? And even this is not only limited to all other very sophisticated sector, even agri, right? What prices of bean right now is trading for the new season. It's not only about a traditional approach that demands supply, right? There are a lot of information. It is supported by a lot of information, whether it's weather pattern, how it's going on, whether it's how soil acidity levels are, what is the vegetative health index as of now, what is the supply chain, everything. And I think the prices now have some value for this information as well. So things are changing continuously, and maybe much larger than what we thought, but much larger space what we thought. And of course, liquidity have improved dramatically. Today only I was reading a tweet which Elon Musk has put that Tesla money in Europe bank accounts is actually depreciating because there is a negative interest rate, right? So kind of liquidity, you can just understand what's happening and where this will money is going to flow if this kind of liquidity is going to happen. So things are definitely very, very volatile. We have a lot of uncertainty, but this VUCA can be changed, right? From volatility, uncertainty, complexity, and ambiguity to something else, right? And if I keep rest of the thing aside and only focus on the price thing, which we are talking here right now, thing, I think futures provide a lot of options to manage these things, right? There is uncertainty, we all know, right? And there is a complexity, there is ambiguity what to do at this point of time, where to buy, where to sell, what to sow, what to harvest, what to store, how long I need to store, when to import, where to export, custom bond warehouse में रखना है या custom bond warehouse के बाहर रखना है, import duty things, government policies, a lot of things are there, right? But ultimately all these things convert into the price, and that if we are able to manage that, I think this VUCA can be changed into another VUCA. uh, so that's what we as an exchange says, that use futures prices as a indicator, right? We do not have any control on the things which are happening around, and those have larger impact on the prices. It may be a small things happening somewhere in the small part of somewhere in the world. It may be a ship somewhere stuck in the Suez Canal, or it may be what a president of a country tweets, right? All these things you cannot definitely manage, but you can manage the impact which can be generated by all of this using a proper risk management policy. And that's what we do say, that futures give you a platform where you can see the prices which have actually absorbed all the information which has come up, which is there floating around the corners, what kind of demand supply, what kind of geopolitical scenario, what kind of weathers, everything has been factored in when price discovery on exchange platform happens. And I think if you start using in that way, that these are the price and this is something which we need to manage, you may be a little less worried about what's happening in other part of the world. So starting from the farmers, if we talk about agri, definitely they can use, they can manage the VUCA. We have futures for 5-6 months in advance. Right now, soybean October and November, which is the harvest time, is going on, trading around 6,000, 7,000, around 6,000 range, much above than what it was last year, and maybe way, way, way above what farmers expect from the government support system, right? But someone need to come forward and get that price using futures market, right? Industries, they started with a negative carry, crush margins, the oil industry, they went into a positive territory, a happy movement for some time, and then again right now soybean 8,000, oil have corrected from maybe 1400 to 1200, and there is no meal export parity, right? What's happening? And even we are not getting the bean as well, right? But if somebody would have hedged when season is started in a structured way, they might be buying soya bean at this point of time somewhere around 4,200 rupees, 4,300 rupees, right? What market is trading is 8,000 rupees. But this is what you have to do, right? We just keep, we have talked a lot about risk management. I think 15, 16, 18 years, Chandrasekhar sir have been advocating industries to come and start hedging. And there are people who are hedging, but there are people who have a lot of ambiguity even on the hedging, that whether it should do it or we should not do it. But the VUCA is always there. You do not know the prices, and you cannot know the prices because it's a market-driven prices. Of course, we can do a lot of post-facto analysis, what has happened wrong, where our demand-supply analysis has gone wrong, what kind of impact we have seen, what we can do to avoid it. But I think hedging provides answer to all the questions. So using derivatives market in an appropriate way, I think provide all the solution to the VUCA. The volatility can be seen as a vision. You have the futures prices, you just have to use it, and it's giving you a vision. Uncertainty can be converted into understanding. You see the prices, you can connect all the dots, and you have better understanding that how a future is futures is showing you the prices. The complexity is going to be the clarity, right? I know the price, whether it's sowing or not, whether it's monsoon or not, whether it's bad monsoon, whether it's a good monsoon, but I have a clarity on the price, which is 6,500 rupees in case a future is available there. So that clarity I definitely have. And of course, the last, the ambiguity, definitely it can be agility. You know the prices, and you just need to do some activity and hedge that price, and move out from VUCA 1 to VUCA version 2, which I have just discussed. So this is something which futures market definitely offer you, and we have been advocating these things since long. Of course, these are the higher volatile time. Industry is a little receptive mode. They have been discussing this, but it comes with a lot of reservation as well. Acceptance about the futures market is quite low, or maybe the doubt we have about the prices is still under the question. But I think a lot of discussion need to happen, so industry and Indian agriculture value chain can swiftly move from VUCA to another VUCA. So that's from our side. Chandrasekhar sir, thank you very much for
Thank you.
opportunity.
Thank you, Kapil Dev, for the very focused exposition. Very clearly, you said yes. VUCA conditions cannot be wished away. It's very real, but we need to learn to manage. And yet, there is a certain maybe mental block or whatever. In fact, I keep repeating, and I've been repeating for nearly 20 years now, that hedging is not speculation. Hedging is not speculation. Not hedging is speculation. If you don't hedge, you're actually speculating on the market. And therefore, it is extremely important that stakeholder, producer, processor, industrial, consumer, trader, importer, exporter, all these people cannot speculate on the market about prices, and therefore they should obviously do price risk management through the derivatives. This is number one. Number two, often if I am a producer of a commodity, and if I have a sense that prices are going to rise, the price of my product is going to rise, then I will not hedge 100% of my goods. I'll hedge only very small, a part of my goods. Similarly, if I'm an industrial consumer of a product, and I expect that those prices of my raw material prices will fall, I will not hedge fully. I'll hedge only a part of it. That's the primary risk management principle. But what happens in our country is that often the Indian mentality or Indian attitude, that we are used to rising prices. We always expect that prices will keep on rising. But commodity markets are not a one-way street. Commodity markets are a two-way street. What goes up does come down. At what point of time it will come down, that's a big question, of course. And that is why it is extremely important to manage prices. This is number one. Number two, I have some thoughts I want to share, maybe not at this point of time. Okay, maybe a little later if time permits. But let me go back to Sumit and possibly also to Kunal. But to start with, let me ask Sumit. Sumit, there are a very large number of agri-processing units in our country. If I recall all those numbers correctly, and I've said this, I don't know, innumerable times, say something like 10,000 dal mills, of which at least 5,000 dal mills must be working. At least 2,000 wheat roller flour mills. About 1,500 edible oil refineries. Sorry, 800 solvent extraction plants. Around 200 vanaspati factories. 16,000 oil mills which crush oil seeds. About 650 sugar factories, covering private sector, public sector, cooperative sector. I mean, look at that ecosystem. It is very, very large. So what should be done to motivate all those people with genuine underlying exposure who are not hedging today? How do we bring them onto the hedging platform? That's a big challenge, primarily. So this is, I thought Sumit is someone who closely tracks all this. I'm sure you'll have ideas which will help NCTEX, and I'm sure I'm going to come back to Kunal also. But let's start with Sumit first.
Sir, it's a very interesting and important question, because if you look globally, the liquidity has to bring on exchange from the participants, from the actual hedgers, and speculators comes to support the hedgers by taking a directional view on the market. If you look at US, the biggest hedgers are the farmers or the commercials, because they grow the crop and they bring the hedge to the exchange, and there the consumer also come take their hedges from the demand point of view, and it become a fairly liquid exchange and a benchmark for the global markets. And similarly, any exchange in any part of the world, like for example China, also got itself built on the similar platform. In India, the biggest challenge in past have been that government is being the determinant of price. And because of that, the hedging mechanism has become one-sided, because you know what is the minimum price or what's the maximum price. And that is where people have refrained from using many hedging practices. But the current environment has made that system redundant, because no more you can only be dependent on government, which has its only focus on wheat, rice, and pulses. But there are a number of other commodities, the way economy is going, and for example, the way processing segment always has to run ahead of the economy, especially the capacities which have come in. And the way Indian capacities have come in, I'll put this way: if we have to become a $5 trillion economy, which hopefully we should, because after we have almost crossed the inflection point. After inflection point, the growth will come from known, unknown various factors, as you have mentioned. And because of that, our processing sector, especially in the food, has to do well, because there is a demographic dividend in terms of population. There is an income dividend. There is a Sanskritization of population, where population wants to move to higher segments, where somebody who is consuming certain this thing, they want to consume the better food.
The
And
aspiration levels are going up.
yes, yes.
That's right.
And there is a food habit change, and there is a migration towards cities. Today's city population in India, urban population, is around 28 to 30%. And as per government forecast only, we have to become 60% by 2030. And it means a sea change in the way we are going to consume food. And especially if you look at these segment, it means a bright days ahead for the processing segment, especially in the food industry. Now, the challenge sometimes is in India, food, when we are looking, running a processing unit, people need to demarcate clearly between hedging and speculation. A lot of time people confuse and end up taking wrong position. And afterwards they blame exchange or the messenger for their wrong decision making. And that is where the financial literacy with exchange right now, or through these mediums you're doing, it's going to take it a long way. So I think risk management as a practice in India, which SEBI is also pushing, I think has to become a mandate. We have to not think from the return point of view, but we have to think from a consistency point of view. And I believe over a period of time, looking at these factors, if you are not taking hedge or you are not risk mitigating, you are taking the highest possible risk. So that is where I believe this mindset, which is already percolating, is going to make our industry more vibrant, more strong. And as you have mentioned, it is going to bring more industry online, and it is going to make it more consistent.
Absolutely. Thank you. Thank you. I think that's a wonderful message and something for NCDEX to think about. Kunal, I'm sure he also has bright ideas. Yeah.
Yeah, I think what Mr. Sumit said, the way in US the hedging process takes place, that is something, you know, if the same similar thing, the awareness at the grassroots level, at the farmer, at the FPI. So I think recently what NCDX is doing differently is they are doing a lot of these FPI programs where they are educating the farmers to encourage the hedging. And I think this movement, if it gains the traction, I think we are going to see a phenomenal increase in the hedge on the NCDX also. So to sum it up, you know, what Mr. Sumit said, India does require higher levels of hedging participation from all eco participants, and speculation is always a part of the future exchanges. So that is not a concern. But I think with the hedges coming back on stream, I think the volumes on the Indian agriculture exchanges will go up quite sharply. So my sense is that more and more awareness programs, more and more such initiatives by NCDAX, I think will definitely increase the participation in manifolds in agriculture market, futures market in India. And I think we are still at nascent level after all these 10, 15 years of inception, and the volumes can really take off very sharply.
Very nice. Thank you very much. I think it's a very positive, very robustly optimistic picture. Very, very nice. In fact, I want to share that I work with a number of farmer producer companies. Many of them approach me. I address them, give them advice, do some hand holding, etc. And even for NCDEX, I have done a few events, both in Maharashtra and in Gujarat. What I have found from an FPO perspective is, I tell them that I can't teach you how to plant, how to harvest, how to store. I mean, you're all experts. That's what you've been doing lifelong. But what I know that FPOs and farmers in general lack is that market outlook and price outlook. They don't know whether to sell today, hold, and sell or sell tomorrow or at a later point of time. What is important is we need to make farmers savvy traders, and it's a big challenge. But at the same time, we need to reach out obviously to them, and then have a dialogue with them, keep talking to them, and guide them, handhold them, and provide to them outlook. Say 1 month, 2 months, 3 months, how are prices likely to behave? Many of these FPOs I know have very limited knowledge about global market dynamics. Many of them also do not have enough knowledge about even government policies, for example, changes in custom duties or changes in import-export policy, etc. I think therefore we need to that education program is exceedingly important. Once we tell them about and teach them how to judge the market, reasonably well judge the market over the next, say, 2-3 months, then, I mean, they will, over a period of time, they'll start gaining that kind of expertise. And then I'm sure that process will bring them onto the exchange, because exchange allows price discovery. Exchange helps you discover forward prices. And that's exactly what they want to know. But they also want to know, why are prices moving the way they do? We all know why prices are the way prices are moving. We know how they are moving, but we should also know, which means the FPOs also should know, why are prices moving the way they do. That is important, and that communication to them will certainly create a lot more confidence in their minds to come back to the exchange platform. I have a question for Kapil now. We know there are a very large number of processing units across the country, a whole lot of agriculture commodities, and some of them are obviously already trading on NCDEX platform. Some FPOs are trading on NCDEX platform. What would be your strategy, your game plan, your communication strategy to reach out to them and to convince them that here is a platform that is going to actually bring them benefits, mitigate their price risk, and help them discover forward prices, etc. What are your thoughts? What are NCDEX's plans? But let me also add, if that's a confidential information, if that information is confidential, you don't have to share. But very broadly, maybe you can tell the participants what you propose to do.
No, this is not confidential. I think I just start with one thing. When currency market started in India, it was not exchange who made it successful. It was the market who made it successful.
Absolutely.
And Kunal can rightly comment on this.
I completely
especially our
agree.
business,
Yes.
especially our business partners, who are distributor of these instruments to the market, right? They have reached to almost everyone in the market to whom they know are exposed to currency, and they have currency risk, right? And that's the success that particular segment brought into the currency, right? Unfortunately, this entire exercise, the raw material risk management was left out, right? We have sold currency to a people who is exporting soybean meal, and we have not sold them risk management in soybean meal, right? And I think that's the gap. And I'm not blaming someone, but I think that is something which has remained a gap because of maybe the fragmented nature, the complex market, and instability this market has seen over a period of time. But I think now that time is over, right? So I will start quickly setting 3-4 points. First, of course, is connecting the primary producer to the market, right? In the US market, 40% of wheat OI remains with the Kansas farmers, right? Precisely. And that is something which we have been missing. There were reasons for that. We are fragmented, we are small, technical know-how, well scattered. But now with FPO things are, I think, shaping up, and we are seeing farmers coming forward and hedging, right? And even if not hedging, at least now they are following the prices and they have queries
Yes.
that what
Yes.
prices these are. So I think this is a sea change in the farmer's behavior while making any kind of decision. And once I start looking at price, one fine day definitely I will look forward to hedge that as well. So a lot of positivity in the farming ecosystem about the prices, futures, and especially put options, which recently we have introduced and got it traded by the farmers. You know, the largest trade by the FPOs on exchange system comes from Bihar, right? So that itself says, that farmers even from the most hunterland is also um, approaching that, and of course a lot of people are working on that direction. So marketing and price risk management is not only talk of the town now, it is being considered as a action point by the farmers and FPOs and all the people, the stakeholders working around them. That's one we are focusing on, and we will keep on doing that. Second comes about the stability. Thanks, you have mentioned earlier, SEBI now is the at the helm of this market, and the stability which we have seen is tremendous. Means in last 15 years we have seen a lot of contracts moving in, moving out, ban, suspension. But that is not now the case. Of course, this is the agri market. Something keeps on coming in and out, but stability from the regulatory and the policy side is much better, and I think that will give comfort to a lot of people who want the financial stability, the market stability when be part of an ecosystem. Third is of course market opening up. We were quite limited to local market. Now bank broking have been allowed, institutional participation has been allowed, mutual funds has been allowed, retail can channelize their money to the commodities market. And even the FPI permission is under discussion now.
Yes.
Some time back there was a news. So that is one. The fourth one, which we as an exchange see, that the primary user of this market, the first hand information, who have information on these markets are the people who are closely working with on agriculture, right? Whether it's input company people, whether it's uh, other people, fertilizer company people, traders sitting in small mandis, and all these people somehow they have been disconnected. They could not connect to the market while they are trading options of Reliance or maybe some other shares, but agree they are not connected. So that is one thing which we are working on. Maybe index was the first step in that direction, that people want to trade some direction. So let's give them a product where they can track the agri as a whole, not individual product. Now, and that that has delivered around 45% return in last 1.5 years, the agri dex. Now we are coming with the sectoral indices. So the people who don't want to into the physical trade, they have reservations about the physical. They just want to do price risk management, and they don't have any tool. Now, hopefully, next time when we will connect, we will have at least two sectoral indices on board and getting traded where people can just trade one particular sector. Agri brings seasonality with it. A lot of price movements happens, price change happens in seasonality. We have mix of product, few from Kharif, few from Rabi, and it becomes difficult market to trade a very composite index. So that comfort and the new products we are trying to give. And of course, focus on risk management, not only by us, by the policymakers, by the banks, by the SEBI. We have been focusing, and I think that efforts we will keep on doing. So, and yes, we have support. The people like Sumit and Kunal are doing tremendous job providing right set of information to the market, which is not actually available for the agri. And that's, I think, I would say, again, a big reason people not to believe what's happening in the agri, right? For the gold, if prices moves, whatever, right? We know, okay, natural gas, there is a cold in US, demand of natural gas is high. People are convinced because of information available, they are convinced with the price movement. In agri, they are not convinced because they don't have right set of information with them, which they cannot connect with the price movement. And I think that is something which is again a prior and foremost a priority for exchange to bring a lot of institutes into the ecosystem who can provide quality research, who can provide information, so market doesn't feel disconnected with the price movement. So these are
You
certain
must
things which we
build,
have
I
been
mean,
working for, and we
let me
will
use
keep
the
on doing
term. Let me use the term. You must build credibility into the pricing. I should be convinced that these prices are moving based on a certain set of well identified and well defined factors, and not nobody is rigging the market. Put it that way. Yeah, go ahead, please. Sorry for the, yeah. So we need credible
No,
price discovery. Yeah, go ahead.
right. And so that's it, sir. We have been focusing on these aspects, and we look forward, industry using for certain commodities. One more thing I would like to cover. When we talk about the Indian market, everybody says, look at the US market, soybean, the open interest is a million, and the daily trade is a million. Here we have one. We definitely cannot draw that line. It's not apple to apple comparison. Liquidity has to be in perspective or in reference to what we have in the physical market. Our physical market is not that liquid. You go to physical market and buy 5,000 NP of bean, you cannot buy, right? And there is a huge price impact. So we are fragmented in physical itself, and that will something will come to the futures, right? So let's not compare it to what's happening in the global market. They are aggregator. They do 1 million ton of soybean. We don't have 1 million ton of soybean any point of time. So that's how our market is fragmented. But yes, any point of day, any of the futures contract is much liquid than any of the physical trades someone wants to do in the in any of the mandi or any of the market. So that is something we have to see in reference and not in a comparison view. And yes, there are certain more things which we have been focusing on, like quality warehousing,
Yes.
thinking about the silos which we have brought using our warehouse service providers. ENWR is something, to bring traceability and trackability in the agricultural commodities along with standardization. So the challenges are huge. There are a lot of dots which need to connect it, but we have been doing that. And now I think we have reached to a point that it should all start working in a good way, and market will definitely have much more confidence to come forward and start using it.
Yeah, absolutely. Absolutely. Thanks for this clarification. I think it's extremely important. You have now begun to connect all the dots, and therefore it's going to become a much more robust ecosystem as a whole. I appreciate. Now I want to announce, I want to mention to all the participants that if you have questions, please post them on the chat box. I should have said it 15-20 minutes earlier, but I'm mentioning it now. If the participants have questions, please post them on the chat box, because it's not easy. It's not often that we are going to be able to assemble stalwarts like Sumit and Kunal and Kapil on a single platform. Therefore, I would think the participants must draw the best out of these experts, these domain experts, and shoot questions at them, probe them, and get the best out of them. You are free to post your questions in the chat box very quickly. Otherwise, we have actually reached our scheduled time. We have slightly exceeded, but I'm willing to wait another few minutes. I hope with Sumit and Kunal it is okay, maybe till 6:40 or something, 6:45. But I don't see any questions flowing in, which also suggests to me that the speakers have spoken so well that they have left no one in any doubt. That is how I would interpret no questions from the participant. But I want to mention, I want to take this moment to share something, which is that usually, as someone in this space for decades, and I've studied the psychology of people, investors, processors, all that, Indians by their very nature know to play only the rising market. Okay. And therefore they are comfortable playing the rising market. Because I put money today, wait for prices to rise, and then sell next week or tomorrow or next week when prices rise, book my profit and walk away. This is easy. But this is going to happen most of the time because we are in an expansionary phase. Okay, the economy is expanding, and therefore prices would tend to rise normally. Of course, there will be corrections without doubt, but the general overall there will be a secular increase in prices, which is what people are looking for. But I think we need to communicate to people, particularly to investors, not to the hedgers, but to the investors, that while you can make money by going long, which is what most people are doing, there are also opportunities for going short. When people go short, they make a lot more money than by going long. All the top, the ultra rich investors in the stock market today have all been bear operators, and they have made their money in a bear market, in a falling market. Okay? And therefore, I think this is something we need to keep communicating. We need to keep telling, particularly the investor community, that it is not that prices are in a one-way street, that they will keep on rising. Prices will correct, and therefore you can also play the short side to actually profit from the downward movement of prices. This is one. The second one is, because you have now options trading, and you have, of course, index, which is very important. Possibly NCDEX can target 2 or 3 categories of market participants. For example, mutual funds and AMCs, asset management companies. I don't know what effort NCDEX has put in to attract participation of mutual funds and AMCs. That is one. Second, of course, you need to talk to very large processors in various agriculture commodities, oil seeds, oils, sugar, wheat or pulses, whatever, all that. You need to talk to them, because they have exposure to the physical market, and you should be able to convince them about the utility of the futures market. And third, I would think work increasingly closely. I'm sure you're doing the working already increasingly closely with all the brokerages in this country. Brokerages can definitely play a very critical role in helping NCDEX gather more volumes, because they have their clientele, they have their customers, they give their advisory, they help them, they give them forward guidance, and therefore working closely with brokerage houses. I think these 3-step strategy, I would think should work very well. But more important than anything else, I have found that you need people who communicate effectively, and whose communication is treated with a high level of credibility. That is extremely important. I know in the earlier stages, 20 years ago, there are some of the earlier exchanges, they were not online exchanges. It was open outcry exchanges. I don't want to name them, but I'm sure most of you, there are 2 or 3 exchanges which actually lacked credibility. There are people who would ask me, can I go and hedge my risk in that exchange? Because I don't know how things are working there. But we have come a long way. Now we have online trading. Everything is documented. Everything is transparent, and a lot more. There is an audit trail, etc. Nobody is privy to anybody's positions in the exchange, and therefore there's a big difference today. But the exchanges also will have to build effective and credible communication to attract the market participants. Anyway, now there is one question that I've seen. Kunal has probably left. He said he's got another webinar. I told you he's a busy guy. How retailer can participate in commodity market? Kapil, any thoughts on that? Retail participation.
Retail can participate like any other normal client. They just need to open an account with broker, activate the commodity segment, and start trading, and choose the instrument and start trading. Now they have futures, options, and index. So it's no different for any retail or any wholesale. You just need to have an open account, active account, and you can start trading. And maybe another way, now funds are coming in. The mutual funds are offering schemes which has commodities in it, right? So if you don't have direct expertise now, but you think that commodities are something which are delivering the result, you can buy a SIP in a funds which is offering commodities, that's also, I think, a good way now to connect to the derivatives market.
Wonderful. I think it's 6:40. We need to wind this up. We need to conclude this wonderful webinar. But before I conclude, I want to again ask Sumit if he has any parting comments, any final or concluding remarks that you would want to share with the participants.
Sir, first I want to say that we all have got richer by your comments and knowledge, because experience is one thing which makes all of us rich. Okay, and your experience, especially on commodity markets, gives a lot of insight. And what is more important, as you have mentioned, let's not look towards the direction of the market, whether it's going to go up or go down. Let's look at the consistency of our business, how we want our business, how we are going to lock our processing margin. Please differentiate your role of speculation and role of hedging. And if you want to grow your business to global size, it can only possible if you take informed risk, and you take the risk largely to capture your processing margin. Okay, because if we look towards, because commodities can be highly volatile, and it can be volatile for an extended period of time, which can take away the entire capital. So it is important for us as an investor, as a processor, as a hedger, to use the right platform in an informed way. And this will make the life of everyone better and happy and risk-free.
Absolutely, absolutely. There's no doubt at all. But attitudinally, the hedgers' mindset is one which is actually different from the investor's mindset. But anyway, let's not get into that. That is why I always talk about what is the communication that should go to the hedgers, and what is the communication which is more nuanced that should go to the investors. Fine. I think we are okay with that.
Yes.
Kapil, any closing comments from your side in 1 minute? Yeah.
Yes, sir. First of all, thank you. I think when you are moderator, then speaker's jobs is little less complex. So thanks for that. I would like to say Indian commodities market have come a long way. It's not a new market now. It's 18 years old market. We have one of the best settlement mechanisms globally, right, which ensures that futures is being settled on the spot market. This is, I think, nowhere in any of the major global markets. They settle future on the futures, and convergence happens automatically. We do force convergence. So I think, and it's now backed by a huge multiple regulator. WDR is there, NCCL is there, and a lot of new things has come up. So it is reaching towards the maturity. Now I think it's the time for the market to come forward and use this market for the reason these are meant for, right? All are secondary. We can make money from the commodity. You can do that in the physical as well, right? But the derivatives market give a lot of other things which you will not get anywhere, starting from the price risk management to transparency and to the settlement guarantee as well. So industry definitely should look forward. We are always open. We are working with almost every associations wherever processors or traders are connected. They can reach us directly, or maybe through any of the people who are working with us.
Thank you, Kapil, for your very active participation. Thank you, Sumit Gupta, for sharing your knowledge, your thoughts. I'm sure they're very, very useful. And I want to thank Kunal. Of course, Kunal has left. And on behalf of the IMC Chamber of Commerce, I want to thank also all the participants. In addition to the panelists, I want to thank all the participants for their for staying back and being a part of this wonderful webinar. And with this, it is 6:45. Let us conclude this. Good luck. God bless you all. Stay safe. Let's meet again whenever there is an opportunity. Anup?
Yes, sir.
Okay. Right.
Okay.
Can I leave now?
Thank you.
Can we leave? Thank you.
Yeah. Thank you. Thank you all.